Hey everyone, today we're diving deep into one of the most fundamental innovations in DeFi, liquidity pools. By the end of this video, you'll understand what liquidity pools actually are and why they exist, how they work under the hood with real examples, the differences between Uniswap, Curve, and Balancer, the newest developments in 2025, and most importantly, the risks you need to know about. If you're new to DeFi, don't worry. I'll explain everything from scratch using simple analogies. And if you enjoy this content, make sure to subscribe for more DeFi breakdowns. Let's get started. Before we understand liquidity pools, we need to understand the problem they solve. Think about traditional exchanges like Coinbase or the New York Stock Exchange. They all use something called an order book model. Here's how it works in simple terms. Imagine a marketplace where buyers put up signs saying, "I'll buy Bitcoin for $95,000," and sellers put up signs saying, "I'll sell Bitcoin for $96,000." For a trade to happen, someone has to meet in the middle. Either the buyer raises their offer or the seller lowers their price. But here's the catch. What if nobody wants to trade at a fair price? What if you want to buy $100,000 worth of a token, but there are only $10,000 worth of sell orders? This is where market makers come in. What is a market maker? Think of a market maker like a store owner who always has inventory to sell and is always willing to buy inventory back. Imagine you want to sell a rare Pokemon card. Without a market maker, you'd have to find someone who wants that exact card, negotiate a price, hope they're online at the same time as you. With a market maker, the store owner, you can walk in anytime, sell immediately at their buy price, maybe $90, or buy immediately at their sell price, maybe $110. The market maker makes a profit from the spread, the difference between their buy and sell prices, $20 in this example. In traditional exchanges, market makers are professional trading firms like Wintermute, Citadel Securities, or Jane Street. They use sophisticated algorithms to place thousands of buy and sell orders at slightly different prices, constantly update these orders as market conditions change, sometimes hundreds of times per second. Profit from the bid-ask spread, the tiny difference between buy and sell prices. Take on the risk of holding inventory. For example, a market maker might simultaneously offer to buy Bitcoin at $95,950, offer to sell Bitcoin at $96,050. They make $100 per Bitcoin traded, multiplied by potentially millions of dollars in daily volume. Why they're crucial. Without market makers, you get thin markets with huge gaps between buy and sell prices, long wait times to execute trades, wild price swings from single large orders. With market makers, you get instant execution at predictable prices, tight spreads, small difference between buy and sell, stable, liquid markets. This system works great in traditional finance, but there's a massive problem when we try to bring this to blockchain: the Ethereum problem. Back in 2019 to 2020, when liquidity pools were invented, Ethereum could only process about 12 to 15 transactions per second, with each block taking 10 to 19 seconds. Market makers need to update their orders constantly, sometimes hundreds of times per minute, to reflect current prices and market conditions. On Ethereum, every order placement and cancellation costs gas fees. Imagine updating your orders 100 times per hour, paying $5 to $50 in gas fees each time. You'd spend $500 to $5,000 daily just on gas fees. The math simply doesn't work. What about Ethereum 2.0 and today's Ethereum? You might be wondering, but didn't Ethereum upgrade? What about ETH 2.0? Great question. After the merge in 2022, Ethereum moved from proof of work to proof of stake. The network is now more energy efficient and slightly faster, processing around 15 to 30 transactions per second on layer 1, the main blockchain. But here's the key point. Order book exchanges still aren't practical on Ethereum mainnet because speed improved, but not enough. 30 TPS still can't handle thousands of order updates per minute. Gas fees remain high during network congestion, sometimes $50 plus per transaction. The fundamental economics haven't changed for market makers. The real solution? Layer 2s and liquidity pools. Today in 2025, we have Layer 2 solutions like Arbitrum, Optimism, Base that process thousands of TPS with cheap fees. Some order book DEXs now work there, but liquidity pools remain dominant because they offer unique advantages. No need for professional market makers. Anyone can provide liquidity and earn fees. Simple, predictable pricing algorithms, perfect for long-tail assets that wouldn't attract market makers anyway. So while Ethereum has improved, liquidity pools aren't just a workaround. They've become a fundamental DeFi innovation that works better for many use cases. This is exactly why DeFi needed a completely new approach. And that's where liquidity pools come in. So what exactly is a liquidity pool? Think of it like this. Instead of matching individual buyers and sellers, imagine throwing all the money into a big pot. Anyone who wants to trade can simply trade with the pot itself. More technically, a liquidity pool is a smart contract containing locked tokens that traders can trade against. Let's use a real example. The ETH/USDC pool on Uniswap. This pool might contain 1,000 ETH, worth roughly $3.5 million, 3,500,000 USDC. Anyone can trade with this pool. If you want to buy ETH, you put USDC into the pool and take ETH out. If you want to sell ETH, you do the opposite. But here's the genius part. The pool uses a mathematical formula to automatically set prices. No market makers needed, no order books, just pure math. This is called an automated market maker, AMM. The first project to introduce liquidity pools was Bancor, but Uniswap made them mainstream in 2020. Now they're the backbone of all DeFi trading. But wait, if there's no market maker, where does the money in the pool come from? This is where everyday people like you and me come in as liquidity providers, LPs. Here's how it works. Step 1. You provide liquidity. Let's say you have 10 ETH and 35,000 USDC. You can deposit both into an ETH/USDC pool. Notice, you need to provide equal value of both tokens. This is crucial. Step 2. You receive LP tokens. When you deposit, you receive special LP tokens that represent your share of the pool. Think of them like a receipt. If the total pool has 1,000 ETH and you added 10 ETH, 1%, you own 1% of the pool and get 1% of the LP tokens. Step 3. You earn trading fees. Every time someone trades using the pool, they pay a small fee, typically 0.05% to 0.3%. This fee gets distributed to all LP token holders proportionally. If the pool facilitates $10 million in daily trading volume with a 0.3% fee, that's $30,000 in daily fees split among all LPs. Step 4. You can withdraw anytime. Want your money back? Simply return your LP tokens to get your share of the pool back, plus any accumulated fees. Important update for 2025. Many protocols now offer concentrated liquidity positions, introduced by Uniswap v3, allowing LPs to earn even more by focusing their liquidity in specific price ranges. This is more capital efficient, but requires more active management. Now for the really clever part. How does the pool know what price to charge? The most basic formula, used by Uniswap v2, is beautifully simple. X times Y equals K, where X equals amount of token A in the pool, Y equals amount of token B in the pool, pool K equals a constant number. Let me show you with real numbers. Imagine our pool has 1,000 ETH, X, 3,500,000 USDC, Y, K equals 3,500,000,000. This means 1 ETH costs about 3,500 USDC. 3,500,000 divided by 1,000. Now, someone wants to buy 10 ETH. They'll need to add USDC to the pool such that X times Y still equals K. After the trade, the pool has 990 ETH, 10 less. To keep K constant, the pool now needs more USDC. The math automatically calculates they need to pay about 35,500 USDC, slightly more than 3,500 per ETH. This is called price impact or slippage. The key insight: the ratio of tokens in the pool determines the price. The more someone buys of token A, the rarer it becomes in the pool, so the price automatically goes up. It's pure supply and demand enforced by math. Why bigger pools are better. A $100 trade in a $1,000 pool equals massive price impact. A $100 trade in a $100 million pool equals almost no price impact. This is why protocols incentivize large pools through liquidity mining, offering extra token rewards to LPs. Now that you understand the basics, let's look at how different protocols optimize for different use cases. Uniswap, standard AMM, best for any token pair. Formula: X times Y equals K, constant product. Versions: V2, simple; V3, concentrated liquidity; V4, hooks and customization, launched 2024. Uniswap V4 is massive. It allows developers to customize pool behavior with hooks, enabling things like dynamic fees, custom oracles, and time-weighted average price (TWAP) integration. Curve, stable swap, best for stablecoins and similar priced assets, USDC USDT, ETH WST ETH. Uses a modified formula that keeps prices very stable within a range. Result: much lower slippage for stablecoin swaps. Example: swapping $1 million USDC for USDT might only have 0.01% slippage on Curve versus 0.5% on Uniswap. 2025. Update. Curve now has tri-crypto pools optimized for volatile assets, like Balancer, multi-asset pools. Best for index-like portfolios and custom ratios. Can have up to 8 tokens in one pool. Allows custom weightings, e.g. 80% ETH/20% DAI instead of 50/50. 2025. Update. Balancer V3 introduced boosted pools that automatically deposit idle liquidity into yield protocols. Newer innovations. 2024 to 2025. Maverick Protocol. Directional liquidity that automatically follows price movement. Trader Joe. Liquidity book. Discretized liquidity in bins for better capital efficiency. Ambient Finance. Combines order book elements with AMM for better execution. The good news: trading fees can offset impermanent loss, especially in high-volume pools. Before you rush to become a liquidity provider, you need to understand these risks. 1. Impermanent loss. The big one. This is the tricky part. Let's say you provide 1 ETH plus 3,500 USDC when ETH is 3,500. Scenario: ETH price doubles to $7,000. If you had just held your tokens, you'd have 1 ETH, $7,000, plus $3,500 equals $10,500. But in the pool, the ratio rebalances. You might end up with 0.707 ETH, $4,949, plus 4,949 USDC equals $9,898. You've lost $602 compared to just holding. That's impermanent loss. It's called impermanent because if the price returns to $3,500, the loss disappears. But if you withdraw while prices are different, the loss becomes permanent. 2. Smart contract. Risk pools are smart contracts. Bugs happen. In 2025, major protocols are well audited, but new protocols carry higher risk. Always check for audits. 3. Rug pulls and malicious pools. Anyone can create a pool. Scammers create fake token pools, provide initial liquidity, wait for others to add liquidity, then drain it. Only use well-known tokens and verified pools. 4. Admin keys and governance. Some protocols have admin controls that could theoretically change pool parameters or pause contracts. Decentralization varies by protocol. 5. Liquidity. Mining token risk. Those extra token rewards? If the token price crashes, your yield disappears. This happened to countless pools in 2022 to 2023. So there you have it. Liquidity pools explained. To recap, liquidity pools solve the order book problem on blockchain. They use mathematical formulas, AMMS, to automatically set prices. Anyone can earn fees by providing liquidity. Different protocols optimize for different use cases. But risks like impermanent loss are real and must be understood. The DeFi space in 2025 is more mature, with better security, more efficient designs, and clearer regulations forming. But it's still complex and risky. What do you think about liquidity pools? Have you provided liquidity before? What DeFi topic should I cover next? Let me know in the comments. If you found this helpful, smash that like button and subscribe for more DeFi deep dives. Thanks for watching, and I'll see you in the next one.